This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. What a great lyric. What an absolutely great lyric. In a time when I was blind, I let you take me in. Do you ever feel like that? Do you ever feel like you've been taken in, blinded to something? Then there's the aha moment, the opening, the clarity. Everything appears in front of you, bright, clean. Usually when that happens, though, it doesn't happen for other people at the same time. You're alone, on the ledge. The others don't yet see it. That's what drives me. That makes me wake up every day. I have fun to expose. I have fun to illuminate, to give clarity. At least the best that I can do with my limited insight, my limited knowledge, is to try and turn that light bulb on for everyone else so you can make better decisions. That's just an exciting thing for me. Maybe it's not for you. Maybe you just say, Mike, you're crazy. I don't really get into this. I love it. A few years ago, in my book, Trend Commandments, one of the last chapters I put in was about an interview between CNBC's Joe Kernan and Winton Capital's David Harding. David Harding, a prominent trend-following trader. This ended up being my favorite chapter of the book. Because on one side, you had the Kernan character. And let's face it, we really don't even know if this is a real guy. He's a character on TV. He's an actor. He could be a fine guy to go have a beer with, but he's paid a lot of money to go on TV and act. And his act includes being smarmy, being hypocritical, being incompetent, having an agenda, hating on people, and showing just outright jealousy. That is his act. Now, it could be his exact personality. That could be him. I don't know. But all I know is that's the act that I see on TV. I can only assume that Susan Krakauer and her MBA types have determined that there is a significant part of the audience that wants that. I mean, Joe Kernan gives the audience what apparently they want. At least that's how it usually works in the TV and media world. So David Harding appeared on Joe Kernan's show. It was called Harding, Master of the Market. You could find this video clip really fast. Harding, Master of the Market. It's out there, easily found. Also easily found is the chapter that I wrote for my book, Trend Commandments, about this exchange, this conversation between Kernan and Harding. You can find that at trendfollowing.com/whitepaper/surprise.pdf. Look, I'm not in this for the personality clash. I mean, somebody out there will say, oh, Mike, you just don't like CNBC. I mean, it's such a simpleton way to think. It's not about the personalities. It's what people represent. It's the ideas. It's the thought process. Again, in the case of Kernan, it's the smarmy, the hypocritical, the incompetent, the agenda, the hating, the jealousy, all positioned as an expert, as an all-knowing expert that you should respect. I don't get it personally. I don't get why any CEO, why any, quote, master of the universe would allow themselves to go onto CNBC and have this incompetent boob berate you, who doesn't even look like he's prepared. That was why I chose to make that the last chapter of my book, in Ten Commandments. I thought it was fantastic. So many lessons, so many insights about how the world really works in the context of this great trading example. Recently, I started looking for information on a trader named Ken Tropin, who runs a multi-billion-dollar fund out of Connecticut, once was the president of John W. Henry's firm. Tropin has had immense success with trend following trading. Now today, he has equal number of other strategies, perhaps even more, that trade strategies beyond trend following. But my job is to educate. My job is to open up people's eyes to how things really work. So if there is a billionaire trader in Connecticut named Ken Tropin, who once was the president of John W. Henry's firm and who still has billions of dollars trading as a trend following trader, to me, that's worthy of insight, worthy of discussion. Through the magic of the internet, I find out that not but a few years ago, Ken Tropin appeared on this same program, this same style show with Kiernan that David Harding had appeared on. Now, I should have expected it would have been something similar to Harding's appearance with Kiernan. Again, the agenda, the hating, the incompetence. Let me play that clip.
You are a quant, kind of, aren't you?
We're a little bit of both. Graham is a firm that has about 2/3 of its business in the hands of what we call discretionary traders. They're macro-focused, so they're not typical long-short equity traders. They're really focusing on trading interest rates around the world. They're trading stock indices around the world. They're trading some credit. So they're really, in a sense, a broad opportunity set of different markets where we can go both long and short. And so we really do not focus on buying individual single names and trying to have a sort of long-short book.
You're kind of a quant, right? That's Kernan's first question. I mean, what is the act? What am I missing? Are you too much of a moron to pick up the guy's disclosure document that's managing over $7 billion, who has made himself over $1 billion? Are you too much of a moron to pick up the information and read one of his white papers that are all over the internet? Or is this, again, part of the shtick? That there's a bunch of fat guys drinking beer that want to kind of like, hey, you're kind of a quant, man? I've already discussed this on my podcast before. Joe Kernan has advanced degrees. He is not a dumb man. So what's with the act? Continuing.
Well, weren't you a futures guy?
Absolutely.
Dean Witter, right? Out on the West Coast?
Not on the West Coast, in the New York office.
You were?
Yes.
And and then you wanted to write a quant program. Did you? And I read you. Did you really? You wrote the code yourself?
You wrote the code yourself. This is just impossible to imagine. A man who's managing over $7 billion in assets, who has made himself over $1 billion, and you think he can't comprise trading rules and test those rules. Please go watch the video to see Kernan's face. It almost looks like he's drunk as he asks the question. Continuing.
I did, and it
what
was...
What code? You know, I do a lot of that sometimes. I prefer a high-performance Pascal. I have no idea what I'm saying, but what did you use, a COBOL? How the hell did you write your own
software
program?
that was sort of designed for trading systems, and in 1993, John Henry, who was one of the prominent hedge fund managers in that era, and I parted ways, and I taught myself how to program in a language that was sort of designed for trading systems. I hired somebody to help me with that process. Eventually invented Graham's early trading systems. Of course, that's a long time ago. It's 20 years
You
ago.
got $8 billion under management now.
7.5, yes.
$7.5 billion, not too bad. And you founded it shortly after, right, Graham? Or
I founded Graham in July of 94.
But you've been well beyond futures. It's just alternative investments. Is it just stuff that's non-correlated that you find important? That's how you do it?
That you find important, that's how you do it. Again, I don't know if Kiernan is an incompetent idiot or if this is just an act. I've been behind the scenes at CNBC's offices. I've seen their, quote, floor. It's like the Truman Show. You see the people over there live right now appearing on CNBC, and then you see the beehive of people running around programming and thinking up all the ideas. So my question when I watch somebody like Kiernan question a very bright, accomplished trader. Look, you can hate Ken Tropin. You can not like Ken Tropin. You can not like his success. And you sure as hell don't have to respect him. You can try to make him look like a fool when he comes on your show, which is clearly what Kiernan is doing. But I also don't have to sit back when I see this clip and say things are all right. And that is where the dynamic of media has changed. Because a guy like Kiernan's not used to criticism. He doesn't want anybody to critique him. He thinks he's high up in the clouds on a big chair and can do whatever the hell he wants. For example, just but a year ago, I thought it was going to be an interesting interchange. I thought perhaps we would get somewhere. There was a Twitter interchange between myself and Joe Kiernan. And we were talking about the David Harding interview. And Kiernan said, oh yeah, Harding, great for an interview. Absolutely no predictions or forecasts about what might happen in the future. I said, so the interview blows if he can't forecast tomorrow? I continued, why have a trader on who does not predict and then ask for a prediction? Kiernan's response to me, why wrestle with pigs when all you get is dirty toodles? Toodles, Toodles. I asked the guy a legitimate question, and that's all he has is to run away. And of course, I got blocked on Twitter. I guess that's a badge of honor, right? Back to the video.
The progression was as follows. Between 94 and 98, all we did was computer trading. And I wrote all of those models in that era. And then in 1998, in an effort to diversify, the sources of alpha that we try and participate in, we began hiring discretionary traders, which, unlike computer models, are more traditional portfolio managers in the sense they're looking at fundamentals to decide what's cheap.
In the seat of their pants.
Tropin is clearly laying out many different strategies. A significant part of his assets trade in trend following approaches. But he is laying out that he has discretionary traders on his staff that are also trading significant assets at Graham Capital. And the first thing that Kiernan can think to say is that it is seat of their pants. Kiernan is looking at a man who manages $7.5 billion worth of capital. And the only thing he can think to say is seat of the pants. Meaning they're a bunch of morons sitting around with no strategy. I don't know what Tropin's fundamental discretionary strategies are. That's irrelevant to me. But to think that somehow or another, people can invest and trust in Ken Tropin, billions of dollars of assets, and to think that there's not some rigidity there, that there's not some process, something they can believe in, is asinine in 2015.
What's cheap,
in the seat of their pants
and so on and so
like
forth.
that, yeah.
And that part of our business has actually become the bigger business. It's about 2/3 of what we do today. It's something like 43 different teams of different traders, maybe 70 people all told.
Is that because you think computers have limits to what they can do? Is that kind of a
It's
a revelation over the time that the gut works sometimes too?
Yes and no. I think that, computers can do terrific things, but it's only one way of making money in markets, and we wanted to have the biggest scope of opportunities we could. The discretionary traders have, in the last 2 or 3 years, outperformed my computers. Computers had a phenomenal year in 2008 and have been a little lackluster since, whereas our discretionary traders have a very steady return profile that's really not correlated to anything else in the world.
Some context as I cut the clip there. That was in 2013 as Tropin was looking back on the last few years. Of course, 2014 was a banner year for trend following. My intention in playing that clip, my intention to putting commentary there, is to show what you, the investor in trend following, to show what you, the trader who might act as a trend following trader, are up against. You are not going to have many people on your side. You're going to have haters. You're going to have outright jealousy. You're just going to have absolute morons coming at you. The trick is to stick to your guns, stick to what you know works, stick to your process, look up to people like Ken Tropin, and then wonder why guys like Joe Kiernan can't learn from Ken Tropin. Go watch the video. Kiernan could care less what Tropin is saying. It's this kind of like, I'm sitting at a bar, half drunk look. I don't care who you are. I don't care what you have to say. Now, wouldn't it be so much nicer for the audience when this very bright, accomplished man comes on to talk about his trading? And I'm sure as hell not saying Ken Tropin is perfect. I don't know that one way or the other. It's irrelevant. But there is enough opportunity to study success there, to study how he has done things, that to not dig in and take advantage of his time to learn from what he has to say, it borders on criminal. Again, I don't know what the whole purpose of these types of shows are. Maybe there's a room full of 27-year-old MBAs that have decided that the vast majority of people that watch their programming want Kiernan to act this way because they just hate themselves. They hate rich guys. They don't want to know about success. They're losers. Maybe that's the whole point of this. I have no earthly idea. That was the beginning of this podcast. That was the setup to get to some meat, to dig into some details. Bottom line, when Kiernan brings a trend-following trader on his show to talk, watch it. Because the lessons there are immense. And if I've missed any of the others, please let me know. I've seen the one with David Harding. I've seen now the one with Ken Tropin. Are there others? I want to know. Following that interchange, I pulled up white papers, and Ken Tropin's white papers at Graham Capital are all over the internet, easily found. Just search for PDF files. I want to break apart some of the wisdom from those papers. As he mentioned, and as many people have told me, Tropin is not a pure trend-following trader. Of course, he has pure trend-following strategies that account for, I think it's about 25 to 26% of all of his assets under management. So several $1 billion are trading as a trend following trader. That's significant to me, something that I can learn from, something that you can learn from. In going through some of his white papers online, let me read some excerpts that I think define trend following from Graham Capital. The success of trend following strategies relies on the existence of trends somewhere in the markets. Since trend followers diversify across both markets and time frames, it becomes quite likely that at any point in time, trends will present in several market time frame combinations. The ultimate success of these strategies depends on balancing the profits gained from entering likely trends against the cost of entering trades and against the possible losses when trends do not emerge or reverse against the profits gained. Trend following is one of the most mature and well-established systematic trading styles with a 33-year track record of profitability. The basic strategy results in a payout profile that is similar to being long options. That is, the strategy experiences large profits when a trend emerges, but relatively small losses when trends fail to materialize or reverse. Continuing. The similarity in payout structures results from how trend followers typically set their trade entry and exit points. Trend followers generally place stop orders to limit losses when trends reverse. However, most trend followers will either not utilize take profit orders or will have take profit orders much farther away from the entry price than the stop loss orders. This asymmetry helps trend following strategies capture the upside when price moves in line with the trend, while capping downside losses when the identified trend reverses or proves to have been false. One last point from this 2013 trend following white paper from Ken Tropin's Graham Capital. Hedgers provide the opportunity for speculators as a whole to earn positive returns due to the open nature of the financial markets and the potential premium for accepting the transfer of price risk. That's a simple sentence, but it is gold to understand how and why. Everyone doesn't get out at the top in a buy and hold market. There are winners and losers. It is a zero-sum game in the futures markets. Everyone will not be a winner. Hence, strategy is key. Hence, the reason that I love to start at the top of this podcast, ripping apart media bullshit and bringing it back to the lessons and questions and thoughts and insights that we might pull from the likes of a Ken Tropin. You might ask yourself, for a white paper that I could pull up and read to you within 2 to 3 seconds, how the hell could Joe Kiernan not do the same thing? Of course he could. He either did not want to or did not do so on purpose. Continuing, I want to pull more from other white papers from Graham Capital, specifically about the trend following segment of their assets under management. Continuing, trend followers will generally capture almost every ex-post long-term trend that appears in any market. However, there is a cost to capturing these trends. The cost occurs when trends seem to appear but end up reversing. The amount of that cost equals the distance between the entry price of buying, selling the particular futures contract and the stop loss price of the particular model. This trading approach is similar to being long options because the stop loss creates a limited downside and the continuation of the trend creates the large upside. This is why the phrase for this approach to trading is to cut losses and to let profits run. Of course, if trends continually fail to materialize, these limited losses can accumulate to large losses. This is also true for any option purchase strategy. For trend followers, the option premium is paid for after an unsuccessful trade is closed when a stop loss has been reached. The premium can also be paid after markets have moved a great deal, profits have been made, and a reversal causes a trailing stop to be hit and some of the profits reversed. Very clean, very straightforward, not a wasted word of insight. Sometimes people ask me for this clean definition of trend following. What is it? I can't really say that there is a clean definition. There are many aspects to trend following. There are many definitions of trend following. But sometimes, for example, in this work that I'm reading from Ken Tropin's Graham Capital, you can find paragraphs that add to the description in a way where everyone goes, I get it. Continuing from Graham Capital. Events do not happen in a vacuum. They are often defined as events because markets are already preconditioned to fear bad news. This is the reason trend following rarely gets caught on the wrong side of an event. Additionally, the stop-loss trading style will limit exposure when it does. When equity markets reach strong negative consensus regarding its long-term outlook, any reinforcing news will drive the trend further. And boy, are we not seeing that in 2015. all types of markets, all countries. The trend starts to move. No one sees it coming. No one predicts it. Then there's the reinforcing mechanism, the news, the crowd. Everyone goes crazy and jumps on board. But it's too late to participate then because your strategy was not set in motion. You need your strategy set in motion long before the surprise event happens, not when it happens. One last comment from Graham Capital. Paradoxically, bear markets cause events more than events cause bear markets. Think about that one. What I like about trend following trading, traders like Ken Tropin, are their perspective on uncertainty. They just don't know what is going to happen tomorrow. But they have strategies that can react to tomorrow and profit. Whereas the Kernan type character, the CNBC type character, they're paid every day to pretend to know tomorrow. Operative word, pretend. They of course don't know, but they're paid to pretend. And as I've mentioned on other podcast episodes, if Kernan is paid to pretend for that strategy to be successful, he needs willing participants. Now, it strikes me as funny. It strikes me as crazy. I don't know who these people are. But somebody must actually sit there and watch and think that this information is coming from the mind, from the mouth of an expert that knows. Even though that person might very well know that Kernan doesn't know anything. Fascinating, isn't it? It's that yin and yang from commentators versus traders. From the outsiders looking in to the insiders that are really doing it. The insiders that are really doing it have a deep appreciation for uncertainty, a deep appreciation that they do not know what will happen tomorrow. To make my point further, let me use the famed Nobel Prize winning physicist Richard Feynman to help explain my point. The uncertainty of knowledge. I will give a homework assignment right now. Go onto YouTube and watch everything that you can watch from Richard Feynman. And as you watch him think, as you watch him talk, think about how much of what he is saying relates back to trading. Almost all of it. Good trading is multi-discipline. Good trading relates to good engineering. Good trading relates to good physics. Good trading relates to good statistics. Good trading relates to good science. We accept engineering. We accept science. We accept statistics. It's not much of a stretch to jump on board and accept the good principles behind a strategy like trend following. And if you're sitting out there and you're saying, well, Michael, I don't really care about trend following trading. I have my own strategy. Well, you better run that strategy through some type of filtering mechanism. You better figure out what your biases are. You better figure out, do you have rose-colored lenses on? Do you have horse blinders on? Have you really run it through the mill? Have you taken all the varnish off? Have you looked under the hood? Or are you one guy by yourself who has dreamed up the one wonderful strategy and only you have figured it out? Because if you can't find other people on your side, if you can't find other people on your team, maybe you really don't have anything. Part of the excitement I've always had in my world was the connective tissue. How could these various men and women in different states of America, in different countries, unconnected to each other, different ages, all develop strategies very similar. You can find proof amongst people. You can find other people doing it. So if you don't like the idea of trend following trading, you don't believe in it, at least be honest with what you are doing. Are there multiple players doing what you're doing, or are you all alone? Bringing it back to an aspect of the Graham Capital Ken Tropin research, the zero-sum nature of markets, I would like to quote a few excerpts from the fund manager John Hussman. Individuals can realize their paper wealth by selling now to some other investor and receiving cash in return. But only a small proportion of investors can actually convert current paper wealth into cash by selling to other investors without disrupting the bubble. Continuing. There's no way for the economy to lock in the paper gains that yield-seeking speculation has produced in recent years. Every share of stock that has been issued has to be held by someone at every point in time until it is retired. For every seller, there has to be a buyer who will hold stocks over the completion of this market cycle. For that reason, there's no sense at all in encouraging investors in aggregate to exit stocks. It's impossible to do so. Now, of course, that commentary from Hussman is right now in September 2015. And what he's really saying is that if you are part of the buy and hold crowd, and you've been that way for 5 years, 10 years, 15 years, 20 years, you really don't have a way to time the top. You're not going to exit. You're going to get caught in whatever the buy and hold strategy delivers to you. That's what you're going to get. Mathematically, Hussman's point goes further. Even if you went on TV and the President of the United States of America said to everyone, get out now, take your profits off the table, go home, there's going to be bad times ahead, it's mathematically impossible for everybody to get those profits. There would be a crash on a massive scale. It just doesn't work that way. Continuing from John Hussman. Put simply, many investors and even some policymakers at the Federal Reserve are under the delusion that paper market capitalization represents real wealth to the economy as a whole. The truth is that the wealth is in the productive assets of the economy and the long-term stream of cash flows they generate. Price fluctuations can certainly affect the distribution of wealth. Those who repeatedly buy stocks from others at depressed prices and sell them to others at elevated prices will accumulate the purchasing power of others. Those who repeatedly do the opposite will surrender their purchasing power to others. But the aggregate wealth of the economy as a whole is unaffected by those price fluctuations. Now, of course, Hussman is making a little bit of a fundamental point there, which is not my point. What I like about Hussman's perspective is that he is clearly pointing out that if you are sitting on the sidelines with your assets, your wealth, dependent on policymakers at the Fed, policymakers in Congress, if this is your livelihood, if this is your life, you're in freaking trouble. Does that mean I am predicting a crash? Does that mean I know what will happen tomorrow? Of course not. But if you have no strategy, you are at the mercy of the machine. You're at the mercy of the system. And right now, for those of you, for those of us that still have a pulse, volatility has awakened. There's a very specific reason that I unfold my podcast. I unfold my work like I do. Once you understand how the game works, once you understand how the best in the business think, you can't go backwards in time. I can't be the guy that comes on and says, buy this, buy that. This is going to happen tomorrow. The bell has been rung. The genie's out of the bottle. I've seen behind the curtain. You can't go back in time. Amazingly to me, there are some people that like my work, but still miss the biggest picture point. They will miss the point of this entire episode. For example, a recent review of my podcast that I saw from somebody that seems to like my work. Quote, I love this podcast for its theoretical, philosophical, and thematic discussions. But the typical detachment from what is happening right now in the market makes it less useful than it otherwise could be. For example, simply spending a few minutes at the beginning giving a trend-following summary of where the market sits in the current moment would make a world of difference. He has world in all caps. How would it make a world of difference for me to say the Dow's at 16,100, or the Dow is at 16,500, or the Dow is at 16,700? How does that make a world of difference? What am I supposed to do? I've now told you, okay, the Dow is at 16,100 as an example. Now what? Buy? Sell? Tell you why the Dow is at 16,100? What do you want me to do? This is somebody that likes my work. They say they love my podcast. The disconnect is amazing, though. The disconnect is that there are people that can seemingly hear the trend-following message. They can seemingly hear the clarity of thought, but there's something else going on inside of their head that does not really allow clarity. They can't release the past thinking. They can't release that desire to think that there's a way to look at a price today and know what's going to happen tomorrow. Here I have a fan of my work. They say, hey, I like your stuff, Mike. But then they want commentary on the moment of right now. The moment of right now? The Dow is at 16,100. The Dow's at 16,500. That's the moment of right now. Who cares? How the hell is that useful? Someone tell me how that's useful. It's only useful if you have a strategy set in motion, a diversified portfolio with risk management, knowing your stops, knowing your entries, knowing your exits, and then the daily price is useful for you. For me to offer commentary on it, well, those very people that come on my show that respect my point of view, that respect that I've done the work to understand, why would they want to come on my show? Why would any intelligent person want to come on a show? I mean, they do it, of course, but this is my show. I'm not changing it. There's a certain ethic here. There's a certain policy that I've established. It's not changing. So even if someone tells me, Mike, I really love your stuff, but why don't you do this, this, and this, and this, which will so happen to violate the last 15 years of your work, but I'm still a fan. Well, I'm not a fan of that thinking. It's just the wrong direction. It's not where you want to be. My motivation is not permission seeking. I'm on my journey. I'm pursuing my goals. I'm pursuing what interests me. I hope I can deliver value to other traders, to other investors, to other decision makers, that they can see clearly some of the lessons that I've had a chance to learn from some of these great minds. What drives me? This drives me.
For the past 33 years, I've looked in the mirror every morning and asked myself, if today were the last day of my life, would I want to do what I am about to do today? And whenever the answer has been no for too many days in a row, I know I need to change something. Remembering that I'll be dead soon is the most important tool I've ever encountered to help me make the big choices in life. Because almost everything, all external expectations, all pride, all fear of embarrassment or failure, These things just fall away in the face of death, leaving only what is truly important. Remembering that you are going to die is the best way I know to avoid the trap of thinking you have something to lose. You are already naked. There is no reason not to follow your heart. About a year ago, I was diagnosed with cancer. I had a scan at 7:30 in the morning, and it clearly showed a tumor on my pancreas. I didn't even know what a pancreas was. The doctors told me this was almost certainly a type of cancer that is incurable, and that I should expect to live no longer than 3 to 6 months. My doctor advised me to go home and get my affairs in order, which is doctor's code for prepare to die. It means to try and tell your kids everything you thought you'd have the next 10 years to tell them in just a few months. It means to make sure everything is buttoned up so that it will be as easy as possible for your family. It means to say your goodbyes. It means to say your goodbyes. It means to say your goodbyes.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.